3 days ago, the Federal Reserve cut interest rates for the third time this year, and the vote was 9-3, which is the most divided rate decision in 6 years. And here is what almost nobody caught in the headlines, because they were too busy celebrating cheaper borrowing costs. The Fed just admitted that inflation moved up since earlier in the year and remains somewhat elevated. And yet, they cut anyway. So I pulled the Fed statement, I pulled the inflation data, I cross-referenced it with the tariff timelines and the fiscal numbers, and what I found is a pattern that explains exactly where this second wave of inflation is coming from, and more importantly, who benefits from the confusion. And I want you to think about 3 questions as we walk through this evidence together. First question: who actually wins if inflation stays elevated for another 18 to 24 months while rates keep falling? Second question: what is the real trigger behind the price increases? Not the headline reason that cable news gives you, but the structural mechanism that is baked into the system right now. And third question: what is the hidden metric that institutional money is watching while retail investors are distracted by monthly CPI prints? Because here is the uncomfortable truth. The inflation everyone thought was beaten never actually left the building. It just changed addresses. And if you understand where it moved, you will see why the next 12 months could look nothing like what the market is pricing in right now. And that is exactly what we are going to trace in the next 25 minutes. So let me show you the first piece of evidence this week. The Fed lowered the federal funds rate to 3.5 to 3.75%, which puts it at the lowest level since November 2022. But look at what else happened in that meeting. 7 Fed officials indicated they want 0 cuts in 2026, and the dot plot shows only 1 more cut expected next year and then maybe one in 2027 before rates settle around 3%. Now, why would 7 members want no cuts at all if inflation is under control? The answer is in the September data, which is the most recent official reading, because the government shutdown delayed October and November numbers. The annual inflation rate hit 3%, which is the highest since January. And that is after the Fed already cut rates twice. And here is the detail that matters. Core inflation, which strips out food and energy, came in at 3% as well. But if you look at the PCE price index, which is what the Fed actually uses for policy, it was 2.8% for both headline and core in September. Now, 2.8 sounds close to the 2% target, but there is a massive problem hiding inside that number. And this is where the investigation really begins. Because the Fed divides inflation into 3 buckets: goods, housing, and what they call supercore, which is core services excluding shelter. And when you separate these buckets, you see something that the headline number conceals. Goods inflation has been well behaved, mostly because supply chains normalized and the strong dollar made imports cheaper for most of the post-pandemic period. But that changed in 2025 because tariffs started filtering through the system. And according to the St. Louis Fed analysis, tariffs now explain roughly 0.5 percentage points of headline PCE inflation and around 0.4 percentage points of core PCE inflation, measured over the June to August 2025 period. That means nearly 1/5 of current inflation is directly attributable to trade policy, not excess demand, not wage spirals, not money printing, but deliberate policy choices. And that brings me to the second bucket, shelter inflation, which ran at 3.6% year over year in September. And here is why this matters. Shelter accounts for roughly 35% of the entire CPI calculation and about 16% of the PCE index. So when shelter stays elevated, it mathematically prevents inflation from reaching 2%, even if everything else cooperates. And let me explain the mechanism because this is one of the most misunderstood aspects of inflation measurement. When the Bureau of Labor Statistics calculates shelter costs, they use something called owner's equivalent rent, which is an estimate of what homeowners would pay to rent the home they already own. And they also measure actual rents paid by tenants. But here is the critical detail. They survey the same housing units every 6 months, which means the official rent measurement is essentially a weighted average of rents that were set anywhere from 1 day to 18 months ago. And when market rents spike like they did in 2021 and 2022, The official measure lags behind by 12 to 18 months, catching up slowly. But when market rents cool, like they have since mid-2023, the official measure also lags behind on the way down. And this is exactly what we are seeing now. Market rents for new leases, according to Zillow and Apartment List, have returned to pre-pandemic growth rates of around 2 to 3%. But the CPI shelter component is still running at 3.6% because it is catching up to the rent increases that happened 18 months ago. And the Minneapolis Fed modeled this dynamic, and their projections show that shelter inflation will only approach pre-pandemic levels by the end of 2025, which means it will continue dragging down the overall inflation statistics throughout the first half of next year. And Fed officials know this. They have explicitly acknowledged the lag multiple times in speeches and press conferences. But they cannot do anything about it, because monetary policy does not affect measurement methodology. But here is where it gets interesting. If you are following along because you want to understand what actually drives markets, not what the financial media tells you, then you will want to keep watching, because what I am about to show you connects tariffs, housing, and fiscal deficits into a single framework that explains the second wave. Now, the third bucket is the one Jerome Powell himself said might be the most important category for understanding the future evolution of core inflation, and that is supercore, which measures services excluding housing. Things like healthcare, transportation, airfares, haircuts, hotel rooms, car insurance, and restaurant meals. And supercore has been running hot all year. The Kansas City Fed data shows that supercore inflation was contributing meaningfully to the overall core CPI increase through most of 2025, and it has not come down the way the Fed hoped. And the reason is wages, because services are labor-intensive. When companies pay more for workers, they charge more for services. And this relationship is especially strong in sectors like healthcare, where labor costs are the dominant input. Restaurants, where wages drive food prices, and personal services, where the product literally is someone's time. And nominal wage growth, while moderating, is still running above pre-pandemic levels, with average hourly earnings growth around 4% year over year, which is too high to be consistent with 2% inflation given trend productivity growth of around 1 to 1.5%. And the San Francisco Fed studied this relationship using state-level data and found something interesting. The Phillips curve, which describes the relationship between unemployment and inflation, appears to have steepened since the pandemic, meaning that even modest labor market tightness generates more inflation than it used to. This could be because firms change prices more frequently when inflation is elevated, or because workers have more bargaining power in the post-pandemic labor market, or because remote work has reduced geographic wage arbitrage, allowing workers in high-cost areas to command higher salaries everywhere. And regardless of the cause, the implication is clear. Supercore inflation is unlikely to fall to 2% until wage growth normalizes to around 3%. And wage growth is unlikely to normalize until the labor market softens further than it has so far. And the labor market is unlikely to soften much because the Fed is cutting rates, which supports employment, and the fiscal deficit is large, which injects demand. And immigration flows have been disrupted, which constrains labor supply. So now you have three structural forces all pushing in the same direction. Tariffs, adding roughly 0.5 percentage point to prices, shelter, stuck above 3% because of measurement lags, and supercore elevated because wage growth has not fully normalized. And this is where I want you to remember door number 2. Because the real trigger is not any single data point. It is the interaction of all three forces hitting at the same time, while fiscal policy is simultaneously expanding. And that brings me to the evidence card that almost nobody is talking about. The federal budget deficit for fiscal year 2025 came in at $1.9 trillion, and the cumulative deficit through the first part of fiscal 2026 is already tracking 18% higher than the same period last year. After adjusting for timing shifts, and the Congressional Budget Office projects that federal debt held by the public will reach 118% of GDP by 2035, which would surpass the historical high of 106% reached in 1946, right after World War II. Now, you might be thinking that deficits do not cause inflation, and historically, you would mostly be correct, because developed countries with independent central banks and reserve currency status can run deficits without triggering
immediate inflation. But the mechanism matters, and right now the mechanism is working differently than it has in the past. Because in prior decades, when the government ran deficits, the Fed was not also trying to lower inflation simultaneously. You had one policy working against the other, fiscal expansion offset by monetary tightening. But in 2025, you have fiscal expansion continuing while the Fed is cutting rates, which means both policy levers are pushing in the same direction, adding stimulus to an economy that is already running above potential output. And this is the fiscal dominance scenario that economists warn about, where the central bank loses the ability to fully control inflation because fiscal policy is too expansive to counteract. And the Yale Budget Lab has modeled this dynamic, and their research shows that if the debt-to-GDP ratio continues rising on its current trajectory, you could see an additional 10% increase in the price level over the next 30 years, purely from the fiscal channel, independent of any monetary policy choices, which translates to roughly 0.3 percentage points of additional inflation per year. And that does not sound like much, but it means the Fed is effectively aiming at a 2.3% target, not a 2% target, because fiscal policy has shifted the baseline higher. And here's the mechanism that connects deficits to inflation, because this is important. The government borrows to cover the gap between spending and revenue, and when it borrows at scale, while the economy is already at full employment, it competes with private borrowers for available capital, which pushes up interest rates across the economy. And higher rates should theoretically slow growth and reduce inflation. But there is a twist, because the government also spends the money it borrows, and that spending flows into the economy as income for contractors, employees, and beneficiaries who then spend it themselves, creating demand. And when you have rising demand meeting supply constraints like tariffs and housing shortages, you get persistent price pressure. This is fiscal dominance in action, and it is the hidden variable that many investors miss because they focus only on what the Fed does while ignoring what Congress and the Treasury are doing on the other side of the ledger. And the interest payments alone are now staggering. In fiscal year 2024, federal net interest spending was $882 billion, which is more than the government spent on national defense or Medicare that year. And those interest costs keep compounding, because as rates stay elevated, the government has to pay more to service existing debt and issue new debt at higher yields, which adds to the deficit, which requires more borrowing, which means more interest payments. And this feedback loop is one of the reasons the Federal Reserve is in such a difficult position right now. They want to bring inflation down to 2%, but they also know that keeping rates too high for too long will strain the government's finances and potentially trigger instability in the Treasury market. And that is why the Fed announced in December that it will resume buying Treasury securities, starting with $40 billion in Treasury bills this week, which is essentially providing support to the government debt market even as they claim to be fighting inflation. And this brings me to the skeptic corner, because I know what some of you are thinking. You are thinking tariffs cannot really cause that much inflation. And you might point to the data showing that import prices for consumer goods actually fell slightly, and apparel prices were flat year over year, and new vehicle prices barely moved. And you would be right, that the pass-through has been partial so far. The St. Louis Fed estimates that only a portion of the model-predicted tariff effect has materialized. And there are several reasons for this. Some foreign suppliers are absorbing costs by cutting margins. Some retailers are pressuring vendors to hold prices. And some consumers are trading down to cheaper alternatives. So the skeptic argument is that tariffs are a one-time price level adjustment, not an ongoing inflation engine. And historically, that is correct. Tariffs do not cause sustained inflation the way loose monetary policy does. But, and this is the crucial pivot, that objection actually becomes a clue. Because what happens when foreign suppliers finish cutting margins? What happens when retailers can no longer squeeze vendors? What happens when the inventory buffers run out? The answer is that the delayed pass-through eventually passes through, and the timeline for that is now stretching into 2026,
which is exactly when the Fed expects inflation to remain elevated, according to their own projections. And companies have been telling us this directly in earnings calls and surveys. The Federal Reserve Bank of Boston surveyed small and medium businesses in August 2025 and found that importers expect to pass through 50% of their cost increases into prices over the next 12 months. And that is up from just 1/3 earlier in the year. And the longer firms believe tariffs will persist, the more they are willing to raise prices because they need to protect margins, and they do not expect relief anytime soon. And there is another dynamic at play, which is that domestic producers who compete with imports have less pressure to keep prices low when tariff-protected foreign competitors have higher costs. So even goods produced entirely in the United States can see price increases because the competitive constraint has been loosened. And this is showing up in producer prices for categories like household furnishings, electronics, and apparel, where both imports and domestic substitutes are repricing higher. And the J.P. Morgan analysis of June 2025 CPI data found that household furnishings and operations specifically showed elevated price growth because 2/3 of furniture and a significant share of other household items are imported and subject to tariffs. And you can understand this mechanism in 30 seconds. Think of it like a dam. When water pressure builds up behind a dam, the dam holds for a while. But if the pressure keeps rising, eventually the water finds a way through. And tariff costs have been building up behind corporate balance sheets all year, and the pass-through dam is starting to leak. And that is the real trigger. Not the tariffs themselves, but the timing of when corporations collectively decide they have absorbed enough and start pushing costs forward more aggressively. And the survey data suggests we are approaching that inflection point, which is why inflation moved up since earlier in the year, even though the Fed had already started cutting. And now, I want to show you something that connects back to door number 1. Who benefits if inflation stays elevated and rates keep falling? And the answer might surprise you, because on the surface, everyone hates inflation. Consumers hate paying more. Businesses hate margin compression. Workers hate real wage erosion. But there are winners. And let me walk you through who they are. Because understanding the beneficiaries reveals the incentive structure that keeps inflation alive longer than it should. The first winner is anyone with existing fixed-rate debt, because when inflation runs higher than expected, the dollars you repay are worth less than the dollars you borrowed. And this includes homeowners who locked in mortgages at 3% during the pandemic. They are paying back loans in depreciated currency while their home values and potentially their incomes rise with inflation. The second winner is asset owners, specifically those who hold real assets like real estate, commodities, and equities that can reprice higher with inflation, because nominal gains look good even if real gains are modest. The third winner is anyone with pricing power, meaning companies that can raise prices faster than their input costs rise. And we have seen this play out since 2022, with corporate profit margins actually expanding during the initial inflation wave because many companies used inflation as cover to raise prices beyond what costs required. But the biggest winner of all is the entity with the most debt, the federal government. And think about the math. If you owe $35 trillion and inflation runs at 3% instead of 2%, that is an extra $350 billion per year in reduced real debt burden without having to raise taxes or cut spending. And I am not saying there is a conspiracy here. I am just pointing out that the incentive structure does not align with aggressive inflation fighting when you are running nearly $2 trillion annual deficits and your interest costs are approaching $1 trillion. And now let me show you the hidden metric that institutional money is watching. Because this is where the evidence board comes together and shows you what the smart money sees that most retail investors miss. And that metric is the break-even inflation rate derived from Treasury inflation-protected securities, or TIPS, compared to nominal Treasury yields. And right now, the 5-year break-even rate is hovering around 2.3 to 2.4%, which suggests that bond traders expect inflation to average slightly above the Fed's target over the next 5 years. But the more interesting signal is in how that rate has moved since September, when break-even inflation started creeping higher, even as the Fed was cutting rates. And that divergence tells you that the bond market is not fully buying the soft landing narrative. Because if inflation were truly beaten, break-evens would be falling alongside rate cuts. Instead, they are stable to rising, which means traders are pricing in exactly the kind of scenario I just described.
Persistent inflation that does not fully return to 2%, but instead oscillates in a 2.5 to 3% range for longer than most people expect. And if that is correct, it has massive implications for asset allocation, because stocks that were priced for a 2% inflation world, with rates falling to 3% or below, will need to reprice for a 2.5 to 3% inflation world with rates stuck around 3.5%. And that is a very different environment for valuation multiples, especially in rate-sensitive sectors like real estate, technology, and utilities. And here is where the math gets uncomfortable. Because the equity risk premium, which is the extra return stocks offer over risk-free treasury yields, has compressed to levels not seen since 2007. And if treasury yields stay elevated, because inflation stays elevated, then either stock prices need to fall, or earnings need to grow faster than currently expected to justify current valuations. And the earnings growth thesis relies on consumer spending remaining strong. But consumer spending relies on real wage growth outpacing inflation. And real wages have been barely positive when you adjust for the actual prices people pay, not the official statistics. And this creates a fragility in the bullish case that most investors are not pricing correctly, because they assume the Fed will engineer a soft landing with inflation falling to 2% and rates falling to 3% and earnings growing at double digits, and all of that happening simultaneously without a recession. And historically, that combination has almost never occurred, and the closest analog was 1994 to 1995, when the Fed managed a soft landing, but inflation back then was already at 2%, and debt to GDP was around 60%, not 100%. And there were no tariffs, and housing was affordable relative to incomes. So the current environment is structurally more challenging than the historical comparisons suggest. And now let me connect the final piece of evidence, which is the rewatch trigger I planted near the beginning. Because I mentioned that the Fed's December rate decision was 9-3 with 3 dissents. And that is accurate, but the nature of those dissents is the real story. 2 members, Goolsbee and Schmid, voted against the cut because they wanted to hold rates steady. They are worried about inflation. 3 members voted for the cut, and 4 other non-voting participants registered soft dissents, indicating they also did not support the decision. And 1 member, Stephen Myran, who is a White House appointee, voted for a larger 50 basis point cut. So you have the committee literally splitting 3 ways: hawks who want to pause, doves who want to cut faster, and a centrist group that went along with the quarter-point compromise. And this kind of division at the Fed is extremely rare, and it tells you that internally, they are not confident about the path forward, because the data is genuinely conflicted. Inflation is too high for comfort, but the labor market is softening, and unemployment edged up to 4.4% in September, which is the highest since October 2021. And the Fed's dual mandate requires them to balance both objectives: maximum employment and price stability. And right now, those objectives are in tension, which is why Powell said there is no risk-free path for policy as we navigate this tension between our employment and inflation goals. And that tension is the master key to understanding everything I have shown you. Because the second wave of inflation is not coming from one source. It is coming from the collision of multiple forces that individually might be manageable, but together create a persistent structural pressure that cannot be solved by monetary policy alone. Tariffs are a policy choice, not a demand shock. Shelter inflation is a measurement artifact combined with a genuine housing shortage. Supercore is tied to labor costs that respond slowly to rate changes. Fiscal deficits are structural, driven by demographics,
healthcare costs, and political gridlock. And the Fed is caught in the middle, trying to thread a needle that keeps getting smaller. And the result is what we are seeing now. Inflation that bounces around between 2.5 and 3.5% instead of settling cleanly at 2%, which means rates stay higher than expected for longer, which means the soft landing everyone is betting on requires everything to go right simultaneously. And if you have been investing long enough, you know that everything never goes right simultaneously. And that brings me to what you should actually watch going forward. Because now that you understand the mechanism, you can track it yourself, instead of relying on pundits who focus on the wrong metrics. The November jobs report comes out on December 16th. And if unemployment rises above 4.5%, the Fed might accelerate cuts even if inflation is still elevated. Watch for that tension, because the Fed has signaled through its dot plot projections that it considers 4.5% unemployment to be roughly the upper bound of acceptable slack, and breaching that level would shift the policy bias more decisively toward employment protection over inflation fighting. The October and November CPI data will be released in the coming weeks. Once the BLS catches up from the shutdown, those numbers will show whether tariff pass-through is accelerating. Watch for core goods inflation, specifically household furnishings and appliances, which have the highest import content. And watch for any divergence between headline and core, because if headline spikes on food or energy, while core stays stable, that is very different from both rising together. The next PCE report will be released in late December or early January, and that is the number the Fed actually targets. Watch whether core PCE stays at or above 2.8%, and also watch the breakup between goods, services, and shelter, because that decomposition tells you where the pressure is coming from and whether it is transitory or structural. And watch the Treasury market. This is the hidden signal that most retail investors ignore. If 10-year yields start rising while the Fed is cutting short-term rates, that is called yield curve steepening, and it often signals that bond investors are demanding more compensation for either inflation risk or credit risk. And in the current environment, it would likely be inflation risk, because U.S. Treasuries remain the safest asset globally. And the comment section is the best place for you to share your read on what comes next. So tell me in one word what you think is the biggest inflation driver right now. Is it tariffs, shelter, wages, deficits, or something else? I read every comment, and the best insights often come from this community because you are tracking different data points and seeing patterns I might miss. And if this kind of analysis helps you understand what is actually happening in the economy rather than what the headlines say is happening, then consider subscribing, because every week I go through the filings, the Fed statements, and the data to find the patterns that matter before they become obvious. And if you found value in this investigation, you will find value in what is coming next, because the tariff pass-through story is about to accelerate, and I will be tracking corporate earnings calls and supply chain data to show you exactly when and where the price increases hit. And that is the kind of forward-looking analysis that can help you position before the move, not after. So now, let me leave you with the master key one more time. The second wave of inflation is not a mystery, and it is not random. It is the predictable result of three structural forces colliding. Tariffs that add 0.5 percentage point to prices. Shelter that is mathematically
locked above 3% for another 18 months. And supercore that cannot fall until wage growth normalizes, combined with fiscal deficits that inject nearly $2 trillion of borrowing demand into an economy already running above capacity. And the Fed knows this, which is why they are cutting rates carefully with significant internal dissent, signaling to anyone paying attention that they are not confident the inflation fight is over. They are just hoping it is, and hope is not a strategy. It is the absence of one. And once you see how these forces connect, you cannot unsee it. You will watch the data differently, you will hear Fed statements differently, and you will understand why the next 12 months could surprise markets that are priced for perfection, not persistence. And this brings me to the final thought. because I know this was a lot of information. But understanding it gives you an edge over investors who only read headlines and react to monthly prints. The headlines say inflation is falling toward target and the Fed is cutting rates and everything is fine. The reality is inflation is stuck above target and the Fed is cutting anyway because the labor market is softening and they are caught between competing priorities and nobody knows how it resolves. And that uncertainty is the opportunity. Because when consensus is wrong, the returns go to those who saw the setup early. And you now have the setup. You have the mechanism. You have the metrics to watch. And you have the historical pattern, which is that second waves of inflation in the 1940s and 1970s lasted longer than anyone expected and required more aggressive responses than policymakers initially wanted to deliver. I am not predicting a repeat of those episodes. I am saying the conditions exist for inflation to stay elevated longer than markets currently price, and the evidence supports that view. And if the evidence changes, I will change my view and show you the new pattern. But let me be
Specific about why the 1970s comparison keeps coming up, because there are structural similarities that are worth understanding. In the 1970s, you had two oil shocks that raised energy prices. You had fiscal expansion from Vietnam War spending and Great Society programs. You had a Federal Reserve that was slow to raise rates because of political pressure. And you had wage indexation that created automatic pass-through from prices to wages and back to prices. The current environment has some parallels. Tariffs are a supply shock, similar to oil shocks. Fiscal deficits are expanding due to structural spending on entitlements. The Fed is cutting rates while inflation is above target, and although formal wage indexation is rare today, Social Security, cost of living adjustments, and union contracts do provide some automatic linkage. In fact, the September inflation data was released specifically to calculate the 2026 COLA for Social Security, which came in at 2.8%, meaning nearly 75 million retirees will see their transfer income rise to match inflation. And that additional spending power flows back into the economy, supporting demand and prices in a reinforcing loop that did not exist to the same degree before automatic indexation became widespread. But based on what we know today, the second wave is real, it is structural, and it is not going away. Because the Fed cut rates 3 times. This is not financial advice, it is education and pattern recognition. And now that you see the map, you will notice things you missed before. Like the tiny detail I dropped near the start of this video about the Fed resuming Treasury purchases while claiming to fight inflation. Because that single fact tells you more about the policy bind they are in than 100 press conferences. And when you start connecting dots like that across filings, statements, and data releases, you stop reacting to markets and start anticipating them. And that is the
skill that compounds over years, not days. So thank you for watching until the end, and let me know in the comments whether you think the Fed has inflation under control or whether the second wave is just getting started. Because your perspective shapes this community, and the best conversations happen when smart people disagree with evidence. And I will see you in the next investigation.